Are you guys ready? We got 800, probably like 1,000 viewing already. I'm pumped. I hope you're pumped. Guys, smash the like buttons, smash the subscribe, share the stream, share the tweet. Today is the day we've been waiting for. Last month, we did not have an FOMC meeting, and it was the saddest day or saddest month of my life because I live for these. On the chart behind me, we have Bitcoin, Dixie, the dollar. We have gold, we have euro. I was going to try to add stocks, but it would get too cluttered. Let's put on mortals while we wait. We have on the chart here marked out when our events are happening today at 2 p.m. We will have the ceremonial Googling for the first person who can find the BPS interest rate hike change. Here's what we're looking at today. With the EU coming in with a 75 BPS hike, this is a big move from the European Union. Right above me, you probably can't really read it, but that's the weighting of the Dixie basket. The euro representing more than half of the DXY. Oh, wow, that's quiet. Let me turn up these tunes. We have a little competition. This is going to put a little onus on Mr. Cherpoww, potentially making them more dovish or more hawkish. We're going to find out together. I am going to go into what the Fed is. I just want to get this out of the way first. Shout out to our sponsors, Bybit, Market Cypher. Check out the links in the video description below. Make sure you're smashing likes and subscribes. Here's how I'm seeing this today. This is my opinion. We have, honestly, 3 outcomes. The market has been looking at a 75 BPS hike since the more hawkish statements from Cherpoww himself over the last month or two, stating that they're looking still to make aggressive interest rate hikes. This is the most neutral outcome, 75 BPS. Likely we will see, I would say, stocks, gold, Bitcoin, maybe mild green, likely more crab trading as we've seen. Not a very interesting outcome at 75 BPS. Here's where it gets spicy. At 50 BPS, they're actually going to be coming in lower than the EU. This is going to put downside pressure on the Dixie and upside pressure on pretty much everything else. That's what I'm hoping for. The lower, the more spicy this is going to get. But that is likely hopium. With inflation, CPI, core CPI, whatever, running hot still in August, those numbers coming above expected, that's not really the likely outcome. The likely outcome, again, going to be that 75 BPS, but there is one more potential outcome, and that would be 100 BPS or even potentially higher. If the Fed is going to get really serious, they may look to make an even more aggressive interest rate hike. This is going to likely moon the dollar. I'm going to pull this up. The Dixie seemingly very excited today, maybe just as hyped as I am, to be honest, as it's approached and broken this year's high. It is again breaking to a multi-decade high into this meeting. Now, I'm going to also preface this with, guys, I've closed my trade. I do not recommend trading during these meetings. They can become very volatile, really, especially with leverage. It can go any way. The slightest body language of Mr. Powell can send markets up or down. Quote Kanye West, no one man should have all that power. And he does. Potentially the most powerful man today on the planet we're going to hear speak. I have over here, you'll see these horizontal bars, rate hike at 2, and Mr. Powell himself speaking at 2:30. So we have some time. Bitcoin didn't expect this, but we should expect volatility. Bitcoin showing a little bit of juice. Getting a little hype. That's not a bad 5-minute candle. I'm going to remind you, these are 5-minute candles, so please keep that in mind here. These are not these are small moves, even if they look large. So I'm going to go over here quick. What the Federal Reserve is and what their tasks are. They're tasked with 3 things as of this year. It used to be 2. They're tasked with monetary policy. They are tasked with unemployment, and they are, as of this year, I believe, tasked with minority income inequality, which I am all about income equality. I think everyone deserves living wages. Just seems a little odd that it's the Fed's job. They are not a government body. However, they work closely with them. So the Federal Reserve is the central bank of the United States. As such, they are in control of the quantity of government-created money. This is also in hand with the Treasury. They have the unique power, essentially, to imagine money into existence. If you take a look, this is all public information. You can see the Fed balance sheet, the quantitative easing that they imagined money into existence throughout 2020. They have now taken a stance to tighten or perform quantitative tightening, which is essentially unloading that balance sheet. Now, they have stated they're going to continue this, but at the rate which they're doing, and I bring this up every month, the rate at which they're increasing interest rates and quantitative tightening doesn't seem to be fast enough to ever get them to their goal. Ever. Like, it would take multiple years. What we've seen in the past is interest rates need to be within about 2% of inflation or CPI data to get inflation under control. We aren't there yet. I believe we're at like 2.5%. Numbers last month coming in at like 8.6. You can tell we have a long way to go. Even with a full percent hike, 100 BPS today, we'd still be far from that goal. So monetary policy is the manipulation of the money supply and interest rates, which are the essential price to borrow money. Throughout the last few years, the price to borrow money has been cheap and or free. With these interest rate hikes, we have made borrowing money more expensive. Now, we can draw out conclusions in all different directions on what that means. If you make borrowing money expensive, that creates less supply or harder. It's a harder demand on borrowers that want to go create new business. When money is cheap, people can freely borrow it and try to start new businesses. It isn't exactly cut and dry, good, bad. It really isn't. That's an important thing, is these aren't good or bad. What they are is, in perspective to what's going on, are we making the right choices? At the moment, stocks are eating it. They're not doing well. They're down harsh. In fact, I want to say they're down about where they were at 2020 during the crash. This is not intentional. However, stocks prices is not something included in inflation, and in my opinion should be, as that's what pretty much all of the United States production and productivity. Let me get back on course. By selling assets that the Fed currently holds, they can reduce the amount of cash banks hold and the amount of loans that they can take and make. Overnight lending. By changing the amount of loans, they can change the interest rates on those loans. They really can manipulate the amount and availability of money that exists. By doing so over the last few years, they've created inflation, and now they're trying to tackle that inflation problem. As inflation is starting to get kind of out of control. Everyone was expecting a little lower numbers last month. They didn't come in that way. Inflation is still hot, and we haven't had an FOMC meeting, and that's why I think today is going to be mega hype. I don't know what's going to happen. I am really interested to watch it with you guys. I love that so many people turned out for these. It's my favorite day of the month, as I said. It's been observed that economic downturns can be made less severe by a cut in interest rates. So here's our problem. Stocks starting to topple a few months ago, maybe at the start of this year. Interest rates were basically at zero. The Fed's tools were very limited. In the past, when we saw this happen, the Fed was able to ease rates, spur economic growth, and provide a soft landing. However, we are not in that position. Rates were low. Rates were at zero. Stocks were crashing. And so now they're in a very unique environment where equities are not doing well, and they're forced to raise rates to combat inflation. We've been talking about this on this channel. It's a strange thing. We've seen gold break a multi-year low. We've seen Dixie break multi-decade highs with inflation running hot. So the dollar seemingly one of the only things going up while inflation runs wild. We also see bonds. The bond yield curve has inverted, meaning the 2-year touched about 4%. We'll probably take a look at that if we have time today. inverting the 10-year, meaning you can get more return on your 2-year US bond than you can your 10-year. That makes no sense and has no incentive for anyone to buy a 10-year bond. I want to get through this. More cash means more loans and lower interest rates. Less cash means fewer loans and a higher interest rate. That's pretty obvious. I already said that. A decrease in these rates is done to encourage borrowing and to encourage spending, and that's that soft landing approach. However, the Fed has the dual mandate or tri-mandate, again, of keeping unemployment low and price stable. The problem here is unemployment is just not budging. In the past, we've seen unemployment begin to rise with economy slowdowns, and essentially what happened is during the 2020 crash, supply and demand contracted to a point where they were still able to hold equilibrium. A recession is probably what we're going to hear questions about today. Pray for GINA. Pray that GINA makes an appearance. We'll tweet at her, hopefully, something very polite and nice. The problem is production slowed down with demand very sharply, and now production is returning to normal with demand remaining mostly unchanged. This is not something I'm familiar with, chat. You guys, welcome to bring your opinions. Just keep it polite. Shout out to Mr. Hart's class if you're watching. Never thought I would be in front of teaching a class, but here we are. This is pretty controversial because monetary policy affects everyone. A poor choice in monetary policy can leave millions unemployed and make pretty much everyone unnecessarily poor. The Fed, in my opinion, I've had many opinions on them. Through these times, I have honestly taken a nicer approach to them, and I think that, yeah, while they probably have their own pockets mostly in mind, I don't think that they really want to bankrupt people. I think they're simply backed into a corner. We've been running this kind of same play for decades, and we've known that it was unsustainable. And now we might be at the end of the road. We can't kick the can down farther. However, we always can try to build road and kick the can and continue this game. That is on the table. That is definitely on the table. We are great at that. There are a few different ideas about what is best for conducting monetary policy. Most economists agree on the basics, but there is a non-zero or a pretty significant portion of economists, man, I can't read, who disagree with this approach to the economy. I'd probably be one of them. However, I don't know. That's not really my expertise. I love charts. I love data, but in no way am I going to pretend to be some kind of, I don't know, macro experienced. I'm a younger guy. I haven't been around for anything like this. Something catching my eye here. Bitcoin just pushed to a new high for the day. Let's go. Let's go. Bitcoin looks like it's feeding into this talk and the dollar. Now, I do want to warn you guys, we have seen very commonly as we watch these every month, we have done this for 2 years. We made it cool. I'm not going to lie. You guys made it cool by being here. I appreciate every single one of you. We have seen this happen, this kind of setup with maybe the dollar falling into the rate hike decision, then once it's made public, reversing, or vice versa, rallying into the hike decision and then dumping. So I'm not going to be really motivated by the pre-hike price action. I'm not going to draw conclusions, but we are going to keep an eye on it. It is very odd to see the dollar reaching higher today. We have seen Bitcoin inversely react over the last year to the dollar climbing. Dollar hit a new high today. Bitcoin, while it certainly didn't rocket to a new high or something, we haven't really seen this happen in months where Bitcoin doesn't seem so afraid of the dollar. This could suggest that market participants are indeed looking for a dovish. People are making fun of me for the way I say it. I say stuff weird. Market participants may be looking for a more neutral 75 BPS hike or maybe even lower. The euro being very telling as well. What's up, Short Stack? Thanks for subscribing, guys. If you haven't subscribed or smash that like button, let's go. Today's the day. Leon McRae, Mala Truba, The Marshall, Joey Copy, Starcher Telly, Harvest Minerals, Soria, RS Canor, Maruo. We got a super chat. What's your outlook on Litecoin? That was from the other day. And Stephen Fowler, thanks for subscribing, guys. Great to have you. Welcome to our fam. Make sure you jump in the Discord and follow me on Twitter. Check out the newsletter. Enough shelling. The Euro. We've been watching the Euro very tightly. I'm actually going to put it on a longer time frame here. We've been watching the Euro very closely as it is the largest weighted in the basket for the dollar. So downside on the Euro means upside on Dixie for the most part. Earlier in this month, the Euro touched a 98.6 cents, whatever, to the dollar, and it was previously trading as high as 125 or 140 even in years past. This month reached a new low, and you can see into this meeting, we have a pretty bearish structure here. I don't know why this keeps popping, keeps going away. There we go. I have a different setup. Technical difficulties. No, come back. All right. Pretty bearish pattern here, hovering over 98.6 cents, losing parity into this meeting. Everything is kind of moving against each other. We see Bitcoin not really struggling. We see the dollar hitting new highs, and the Euro. I will say that this pattern is looking to break to the downside and potentially set new lows, but into the rate hike, into the decision, we're seeing some green candles just off the low. Parity though, or 1-to-1 euro to dollar, still seemingly high above us. It's going to be an interesting one, guys. I have this feeling, man. I've been hyped. I'm ready. My body is ready. Bitcoin is ready, it seems. Trading above 19,300. Maybe I shouldn't have closed my long. Whoops. I don't always get it right. But I'm not taking the volatility here. We could see, like we said, easily this could reverse in a very sharp manner. Now, let me make sure I have everything set up. Do I have everything set up? Do we have it set up? We have 2,000 viewers. 2,000 viewers. Let's get 9,000 viewers just so I can say it's over 9,000. I'm going to pull the chat up, guys. How are you feeling today? Vote in that poll. 51% looking for that 75. I think the market is pricing that in, or has priced that in. But a large percent of us, looks like 41%, looking for potentially 100 or higher. That is a spicy outcome. How much lower can it dump StarMade? What's up, StarMade Productions? I remember that name. Tony C, how you doing? Wyatt Entertainment. Sell it when it starts. Everyone, you are to make your own decisions here. We don't give financial advice. I just share what I'm thinking, my knowledge. Please don't ever take it as financial advice. It is not. Can you vote in poll but not smash like? Tyler Zappa. I mean, you can, but then you're not invited to my birthday party. Dean Lowe feeling pumptastic. Okay, all right. Some good vibes. I'm feeling hype. I'm hyped for it either way. Does not matter to me. Well, maybe it does. But I'm more hyped that we're going to get to see my favorite Cherpoww. I'm probably going to see my wonderful future lady wife, GINA, someday, maybe. Just kidding, GINA, if you're out there. Wouldn't it be wild if GINA watched this once? That'd be awesome. More like, says Robbie. That's right. We have 700 likes, guys. Let's get to 1,000. Let's get to 1,000. Let's hype it up. We can do it. In fact, we broke 420, and that's excellent. That's excellent. It's so excellent that let's just give away some memberships. We'll just start it. Let's just start it up, crank it off. Hopefully, it's not going to show any of my info. There we go. We'll throw out 5. We'll just throw them out there. Gina plays for the other team. Mr. Tech Goody, yes. And Gina, if you ever do tune in and see this, I do know you are married to a wonderful lady, and I respect that. You just happen to be the apple of our eye here. We love you. We support you. You have the best questions. Let's go. That's right. What's up, Crypto Stevo? Good to have you here. Shout out to the Optical Art community. Optical Art, I don't know if you're here, Steve, brother. But you the man. You're the yin to my yang, as I say. Vanessa, you're ready. Oh, yeah. Oh, yeah. We're definitely not going to listen to all of those because it will play them in a row. We've got Bullish Crypto, my man. Welcome. I'm glad you won, Vanessa. That's 2 for 2. Crypto Bolts, that's a newer name, but welcome and congrats. Ika Hisalo and Matthew Hoffland. Great to have you guys. We'll probably do more. Don't worry. Ooh, we just got a bunch of subscribers. Jirgo, Kirkum, Nephilim Hunter, James Andrews, Divukas, Admiral, Malik Amar, Detox Dad, Kubel, FPV. What is up, fam? Welcome. Don't forget to keep smashing those likes, share the stream. Check out the links in the video description below. We have less than 10 minutes. We're going to turn these charts to the 1 minute. We have less than 10 minutes to go until the interest rate hike is in. I'm going to put this up so you can see it a little better. There we go. Going down to the real small time frames now, boys and gals. There we are. The dollar showing weakness into it. I'm not going to be fooled. I said at the start, I'm not going to be fooled by it. We have seen price trend in one direction, and as soon as this comes out, it immediately reverses, retraces all those, the gains or losses. How do you get gift memberships? You do have to enable them. It should prompt you when you join. I don't know. Say your name. Pata Nahi. What's up, Pata? It should prompt you if you want to accept memberships. I don't know why you have to like agree, but whatever. And then YouTube randomly just decides the moment we give them out who gets them. I don't get any choice. My never-ending love for GINA. That's right, beauty with Zarpash. You are beautiful, Zarpash. Shared the stream all over the net. Lambretta, my fam. Abid Hassan, you're the man. You love me, I love you too. I love you all. I am here for you guys. I'm happy that we have turned what is probably the most boring, no one ever wanted to watch event into maybe the hypest day of the month. That's right. We did it. We did it, fam. I know some of you just tune in for these, and that's fine with me. I'm happy you're here. Gina, get out, Thomas. Mine. Oh, Gina. Well, hey, that's up. That's between you guys. You know, I got love for everyone. Chris Williams, what's up, man? AMM short hunting before release. I wouldn't doubt it. Like we said, we do see a lot of the time price, especially on the dollar or Bitcoin, into these meetings trend one direction into the rate hike and then just instantly retrace everything. Like just snaps back up. Sometimes we actually see the candle on like the horizontal marked out here. So on the chart to our right, we have the stream start, which I guess we don't really need, but I'm going to keep it there. We have the rate hike. Boom. That was loud. The rate hike bar right here, and then Cherpoww speaks farther out. We love to see kind of the interaction between these. And it's fun because charts actually do move on this. Cherpoww, probably the most powerful human on the planet. What's up, Krishan? Muhammad Tariq from Pakistan. Shout out to Pakistan. Welcome to our fam all around the world. I love you all. Lord of the Rings, 17K Bitcoin. Man, 7K Bitcoin, that sounds like a good deal to me. Steve's in the house. What's up, Steve? Pata, thank you. You're making me blush while I'm live, brother. Super Bowl. It's the Super Bowl of global economics. Actually, it is. Cherpoww is trademarked. Not actually, but is trademarked in our hearts. If anyone else ever says Cherpoww, they owe us a quarter. I made that up. What's up, Christopher Bristow, Cast, Sean Dillard, Emrit. What's up, Emrit? Alice, Scordenjack, Ramiz El Khor. There's so many of you guys. Everyone's hyped for Cherpoww. How did this timeline create? How did we get here? How did we get here? We're in the middle of the bear market, and we have 2,000 people viewing, waiting to hear Cherpoww. I love it, man. I love it. I'm hyped. I'm just so ready. Last month was such a tease not having it. Much love, Malik. Desert Dog, how you doing? Gina brought you here. Tarun, yeah, well, she brings me here. She's the love of my life. Your name is not Pata. Real name is Vivek. Vivek, I love you too, brother. From the Fellowship of the Rings. 1 ring was given to the Lord of the Ring. 2 rings to the bulls. In the House of Crown. Cherpoww! Cherpoww, we've got less than 5 minutes. We have less than 5 minutes till the rate hike is live. Here's what we do. We do this every month, right before the hike. It will be at exactly 2 p.m. East. I guess my watch is dead. I don't need to wear it. Okay. Exactly 2 p.m. East. It is 1:55 p.m. East. So we have less than 5 minutes, and here is your task. We do this every month. Open up a browser tab. And we're going to use the power of all of us to find the interest rate hike first. It's a little strange the way they do this. I don't know why they do this. There might be method to their madness. It might be random. But essentially, they will release the hike at 2. But they'll only release it to like news sites for some reason. It just seems silly to me. But what we do is we all open a browser tab and we get ready. We get our Googling skills ready. And between all of us, we find the hike first. I have some tips on this. My tips are, if you go to Google and we shouldn't all like Google the same terms. Interest rate hike. Here we go. I have some tips. If you go to Google and go to tools, you can go to sort by. I got to turn that off for a second. Window capture will hide this. Okay. You can go to more anytime. And what we're going to do is we're going to sort by past hour. Now, we won't have it yet. We're going to have articles that aren't right, articles that are speculating. No one has the answer until 2 except for Cherpoww himself. Okay. So what we're going to do is once we get to 2 o'clock, we're all going to hammer Google. We're all going to be looking for the most relevant recent posts. And I want you guys to put it in chat, but please cite a source like the Wall Street Journal. You could cite them. They're saying a 75 BPS hike is expected, but we want a real source. CNBC, CNN, ABC, Bloomberg often has it quickly. We want them to confirm it. And it will have to be a post after 2 p.m. So it will have to be a post made in in more than 2 minutes from now. So none of these count. And with your help, we will get it first. We're going to crash Google. That's the goal. We're going to crash Google. 50 BPS because vote is vote. Hey, so I'll recap. My 3 outcomes are less than 75, 75, or greater than 75. Less than 75, markets, in my opinion, will go nuts. We will see markets go nuts. That's what I'm expecting. If we have under 75 BPS. The reason being it is less than what the market's expecting. But more importantly, it is a lower interest rate hike than the EU performed earlier this month. And that's going to give the euro an edge over the dollar, at least in people's minds. Remember, markets are mostly speculative. They aren't really based in reality most of the time. And that is going to be, in my opinion, a driver. That is going to make markets, we're going to see lots of green. 75 BPS is what's expected. If we get 75, that really shows the Fed hasn't changed their stance. It's going to come down more to what Cherpoww says. And we're going to be listening to what he says the future looks like, what inflation looks like right now, what their thoughts are on inflation. And if he says anything about the euro, the JPY, the Japanese yen, the sterling pound, the Canadian dollar, the Swedish krona, and the Swiss franc, the other pieces of our weighted Dixie basket, if he says anything about them, that might be really insightful information. If he even acknowledges that the EU performed an interest rate hike, that could be information that we use. His body language, are his hands shaking? We should make a new poll. I'd say there's like 100% chance his hands are shaking. The last time you could tell how nervous he was. You have to cite a source. That's correct. We have less than 1 minute. Get your Googles ready. Smash the like if you haven't yet. Subscribe if you haven't yet. Get ready. We're going to be the first ones with this info. 420 basis joint says full ratio. I agree with that. I support it. BPS FOMO outcome that is true. We have BPS FOMO. It's okay, guys. Let people spam. Please keep the spamming to like relevance. But here we go. We have less than 60 seconds. Get your Googling on. Get your Googling on. 15 minutes ago. So this one won't count. Right here. That doesn't count. It has to be. Actually, it has to be an article. It isn't even published yet. We have 15 seconds. Get it hype. Get it hype. Put it in the chat. Put your source. We will get it. We will get it. Here we go. 5, 4, 3, 2, 1. Google. 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 Reload. Reload. Google. Reload. Reload. Google. Reload. Google. let's say like Fed interest rate hike 21 minutes ago. It has to be in the last minute. September 2022 has to be in the last 1 minute. So none of these count. We're seeing 75s, we're seeing hundreds. I don't see sources. I need sources. Give me the source. 75, 75. I need a source. Give me a source. BTC free fall. Woo. Woo, 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 woo. We're looking hawkish. What do we got? 75 Bloomsburg. Interesting. Bitcoin is taking a giant dump. Dollar is flying. Gold is dumping. Euro is dumping. We're looking at that's feeling hawkish to me. Holy crap. These are 1 minute candles, guys. So don't freak out. Don't freak out. It's just 1 minute candles. 75 Fox News. Okay. Interesting. I wasn't expecting this much volatility for 75. 100 CNBC. We're having conflicting. Can we get some confirmation? Someone in blue. Tom G said 75. Dump City. What do we got? It has to be in the last minute. We say Fox News. Spark. Let's say Fox News. That's 11 minutes ago. I need something now. I can tell you right here what the charts are saying is that this is coming in hawkish. So it's got to be 75 or above. Easy. 75. All right. USA Today, 75. I'm still not seeing anything in the last minute. I wish I could like search by the last minute. I'm still rooting, even if the decision's out, I'm still rooting for a 69 BPS. Terminal rate 420. 75 USA Today. 75 CNBC. 69. I mean, that's close enough. Holy dump. Yep. Wow. Yahoo Finance 75. I think 75 is the winner. It does appear that way with almost 3,000 votes and more than half of us looking at 75. It appears we were correct. Pat yourself on the back. 75 Bloomberg, 75 Forex Factory. Whew, today is a spicy day. Gold. Did gold break its low? Let's check. Let's peek in here. Let's peek. Gold in the last minute dumped to a new low. Oh, the fallout. No, it didn't dump to a new low. Okay, we're good. This is going to concern me. If gold dumps to a new low, that will absolutely concern me. I put an alert. Let's put it back on the 1 minute because this is spicy. We've got spice. So who was paying attention earlier when I said it is very common to see price trend one way into the hike, and then I said even often right on the horizontal on the minute for it to reverse. That's exactly what happened. Holy heck. Dollar trading to a new high today. Bitcoin stocks. We're going to take a look at S&P. 11105 was the previous daily high. That has moved up. We have a new daily high on the dollar. This is a new multi-decade high for the Dixie. Let's zoom it out here and we can get rid of this. Get rid of that. Put it on something where we can see the dollar breaking higher on 75. I would have expected this to be more 100 plus with this price action. In my opinion, not much in the way for the Dixie. Back to 2001's high at 121. We've been saying that for months. This energy on this FOMC rate hike does seem to be fueling it. Gold is taking a beating. Let's pull open stocks here. Actually, let's take a look at Bitcoin. How bad is the damage for the corn? How bad is it, corn? That is an ugly candle. Luckily, this hourly candle just opened, so there's plenty of time to dump further or retrace higher. We'll see. That is a wild volatility. This is why I said I closed all my trades. I don't have any interest in having a trade open because we almost always see this wild kind of whipsaw price action. That is a 5 minute candle. Minus more than 5% from its open. Holy shizzle. That was 6% in what looks like, 1 minute. That was, 6% candle in 1 minute on the rate hike. So if you weren't convinced before that these rate hikes are pretty much in control of everything right now, you probably are convinced at this point. Let's see, I got some alerts. S&P broke. Let's look at stocks. What's going on in the stocks market? We now have less than 25 minutes to the Cherpowman himself. Faces. Oh, we didn't get that bounce. We did not get that bounce. Where is S&P? To the Cherpowman himself speaks. We have less than 25 minutes. Get hyped. Get ready. Get rocking and rolling. This was an even older chart. S&P 500 trading to a new weekly low. We're going to dump this because this was like our theory of maybe we could see a retracement into the FOMC meeting and we'd be looking around here. Did not get it. Did not get it. Not at all. Is S&P taking a beating along with other markets, it seems. 3,639 was the low in June. We have a new weekly low for this week. Yep. The week went back, filled the daily gap, and is sinking lower. Let's put a line here. Boop. There we go. Wow. Stocks taking a beating into this meeting. Bitcoin taking a beating into this meeting. Euro dropping. Did it drop to a new low? Euro, we looked at this earlier. It hadn't happened. Now it did. Euro really, really feeling the pain here. 1.37% down today. Doesn't sound like a lot, but in Forex, that is a crazy move. It has broken 986. We have a new low. Let's move our horizontal. The whites are just indicating kind of the local highs and lows. They're not suggesting support or resistance or anything like that. Whoo. Whoo. Spicy. Dixie looking to retest. I'm getting alerts. Gold 1650. Jeez, I can't even keep up with this hype. Are you guys ready? Are you ready? What do we got? Rip Europe. Well, let's pray for our European brothers and sisters out there. Everything's getting more expensive. Everything's getting more expensive around them. Bitcoin getting cheaper, apparently. I'm sweating. Don't be sweating. Don't sweat. You don't need to sweat. We're here together, fam. No matter what, we're here together. Vix just dropped. Kelly Boy, you're doing great, Tom. Thank you, Kelly Boy. Shout out to you, my friend. Shout out to everyone who's subscribed that I missed. You deserve to be shout out. Boslav, Kixer, Majin Buu, Bruno, the classic IT guy, Online Moves, Fruit, I can't even pronounce that, Tom Rack, Marco, Dr. Zebra, Henrique, Dinesh, Brett, HB, Muhammad. You guys rock. Keep it coming. Keep smashing the likes. Follow me on Twitter. Sign up for the newsletter. Check out our sponsors in the video description below. You know the shill. I don't have time for that. I don't have time to shill. What I think I'm going to do to make this a little easier for everyone to view is I'm going to put an alert here again on gold. I'm going to put an alert on euro right here. And what we're going to do is we're going to make this chart a little easier to see. There we are. Bitcoin and the dollar back to trading inversely, it seems. We have how long? Not very long. Wait, having trouble. There we go. Cherpoww speaks coming. 21 minutes. Shout out to John Powell. John Powell, are you Cherpow's brother? Where's GINA? GINA. Alton Henderson. What's up, my friend? Need Powell. Powell is coming. Less than 30 minutes. We have 21 minutes to go. You'll be watching GBP. We did talk about that, but I didn't pull it up. Maybe we should take a look at GBP. We should also look at JPY, to be honest. GBP. Yeah, me here with a name that doesn't need to be mentioned. Well, I'm mentioning you anyway, but I'm not saying your name because it would be mean. GBP. GBP USD. Or is it USD GBP? Okay, I have to make a new chart. I can feel the spice. Can you feel the spice? Zeth Buchanan. Looking for a pump, alright? GBP. I mean, that would be pretty cool. I wouldn't be mad. GBP taking a beating. Taking a beating. Let's see what it looks like on the day. Oof. Yikes. GBP breaking below March 2020's low. What we're also going to pull up here is JPY USD. This is the second heaviest weighted currency in the Dixie. So what we're expecting to see on virtually all of these is a red candle, right? Because Dixie just broke to a new high. Ooh, JPY is really down. JPY testing 1997's low today, it looks like. At 0068. Currently at 0069. That is a 20-something year low. JBP right here, the second heaviest in the basket. Looking at the British pound, the sterling, you would think, well, probably going to break. JPY probably looking to test that 1997-98 support over there. If it's going to follow the JPY's lead. Let's see. Wow. Ooh, yikes. The pound... Wow, the pound may be looking to trade to parity. Can anything withstand the power of the dollar right now? Holy crap. Holy crap. We are seeing virtually every currency on the globe just meteor smash. JPY down. Sterling pound down. Broke 2020. Broke 2020's low. That is no bueno. That's not good. There is virtually no support below the pound until parity. That would be 1984. 1984 support. Wait, 1984. Isn't that the year that 1984? Isn't that like the Big Brother, big government tyranny thing? 1984. The book. No time to think about it. GINA, save us, GINA. GINA, save us. What is the Fed gonna do? Oh, they're gonna crash everything. Dollar hit its new high. It's looking like it's flagging out. This is on the 1 minute chart. Please don't do a 1 minute TA. This is a 1 minute chart. 1984 Orwell. There we go. That's what I was thinking. Reached a new high. A little bit of pullback, but really not much. This, remember, 111578. This is just today's high. This is not a resistance of any kind. And in fact, I don't think that there is really any resistance above it of significance till 121. Welcome to argue that with me. That is my own take. Bitcoin trading completely inversely. What a candle. You can see the similarities in this 1 minute again structure, please. 1 minute. Do not make like a plan based on this 1 minute right now. I'm just kind of describing the general price action here. Literally inverse. If we invert the chart, I think that we will see these look exactly the same, and of course they do. Look at that. Uh-oh. Spaghetti-o. Can we check the peso? We can check the peso. Sure, why not? When in Rome. When in Rome. What is it? What is the peso? Hey, let's just type in peso, see what we get. Peso USD. MXN. MXN, the peso. The peso. I will be honest, I'm not sure I've ever looked at the peso. Interesting. Sure sound very right. Interesting, the peso not as impacted. That's interesting for two reasons. I have one more we need to pull up. Going on kind of this idea, the peso, or Mexico, and Canada are the largest trading partners of the United States. So interesting to see their response here. CAD nosediving. We're seeing 1 CAD equal to 75 cents and dropping. Looks like 2020's low on CAD. 68 cents to the dollar. Back to the peso. Peso surprisingly unmoved. This is on a daily time frame. This isn't the small time frames we were just looking at. We've zoomed back out. Weird. The peso looks weirdly bullish to me on the daily. This is daily. Unflinching into this FOMC interest rate decision. Has the peso bottomed out, I wonder? I need to look into Mexico's monetary policy, because this does not look bad. We just saw GBP break March 2020's low. The peso looks unfazed. It's just in a tight range here, not really moving. It may have found like a critical support. CAD not doing so hot. GBP continuing to fall. I mean, it's hard to pick any other target. 1-to-1. Whew. Woof. What a bloody day. GBP, where are you? Dollar and Bitcoin trading virtually inverted. That's no bueno. No bueno. I can't believe we're getting that much move. Ruble. Sure, we can pull up the ruble. Can't believe we're getting this much of a move on 75 BPS. I appreciate you. Aaron. Aaron. Montiel. I appreciate you, brother. USD Rube. Let's see on the day. Let's go to the hour. How is it responding? Honestly, similar to the peso. Not a lot of movement off of this at all. But you can see it already had a ton of volatility into the conflict at the start of this year. I guess as the conflict settled down, and it's still going on technically, right? Trading at 60. Or if you prefer, Rube used. If you want to look at it this way, 1 ruble trading at 16 cents. 16 cents. That's actually, yeah. Rube USD Rube, they're the same chart, by the way. They're just inverted. A little inversion. There you go. A little inversion lesson here. When you switch the pairs, you just invert the chart. That's it. Same thing. Yeah, ruble not really moving into this. Interesting. GBP absolutely taking a beating. CAD taking a beating. The peso, shout out to whoever recommended that. The peso not really doing anything. Not really doing anything. JPY, Japanese yen, not really doing anything. It looks like it had a little wick right here. Although it might just be filling this gap. That's not great. Wow. I'm sad. I've never had so many Forex alerts, man. Jason Snow, why don't you ask the same question 40 times? What question? How much are they raising? 75 BPS is what we are hearing. They won't stop rates until 2024. Honestly, that's like on course with kind of the estimation we did at previous streams. It's going to take multiple years of this. That doesn't seem like they're going. It doesn't really seem like the markets will be able to handle that, does it? What do you guys think in the speech? We have 10 minutes-ish to the speech. 10 minutes till Cherpoww goes live. We're going to be watching it here. We're going to be watching it here. That's right. It's on breaking news. How's the SEC doing? I don't have time to do them all. I'm sorry, Matt. Maybe I can pull up the SEC just to see how it is. We don't... GBP, CAD, Mexican... Okay. Let's make it real confusing. Boom. 6 charts. We'll look at the SEC. Because that is part of the basket. Oh man, this chart looks bad. SEC dumping. Everything dumping. Jeez. Every other currency seemingly just getting obliterated into this interest rate decision. Wow, I'm blown away. We've been talking about how 75 BPS has been baked in, how people are expecting it. From what I'm seeing on the charts right now, it does not look like it was baked in. Does not look like markets were prepared for this. The Russian ruble, we looked at the rube. The rube is really unfazed. It's unfazed. CNY? Sure. Sure, William S., because you're the man. The yawn, yeah. I should have just pulled up all of them that are in the basket, huh? That would have made sense. This CNY not moving. I mean, we have the same daily kind of thing going on, but not we don't see the immediate move that we saw on many other Forex pairs here. I mean, CNY, the Chinese yuan looking for 14 cents on the dot, 13.92. Not a huge move from here. Down, and I'll have my bar change values on this chart because didn't expect it. Down about 0.5% today. We're seeing across the board, maybe 1% down. Major alts pushing. Let's check out what's moving. I don't see anything. Looking at the top 100, biggest gainer in the last hour is only 1.4%, something I've never heard of. 24 hours, sell, we don't count sell. ApeCoin, not much. Crypto, definitely not. I'm not seeing those alts you're talking about. Atom, down 3%. Biggest loss, only 3%. This is kind of interesting. The biggest loss in the last hour is only 3% in the top 100 for Atom. That's not big. We've literally seen like currencies drop more than that in the last hour. That's pretty spicy, actually. XRP is pumping, is it? I'll pull up XRP. If it's not pumping, it can't be though, right? Because I just looked at the top hourly movers. Nice daily candle there on XRP. I can't get too distracted though, because we got Cherpoww very soon. XRP, I said it on across the blockchain yesterday. I said it during our live stream. If it broke 39 cents, it was looking pretty good. It did close. It's daily above 39 cents. That's the highest daily close yesterday in 100 days. XRP given signs of maybe having bottomed out here. We'll find out. I put an alert. It's not pumping at this moment, so we don't... I mean, it has a nice little green candle here, 2%, but not going to look at it now because we only have 8 minutes for Cherpoww. We got to get ready. CMC is garbage. I don't use CMC. I use CoinGecko. Highly recommend you use CoinGecko. It's a great source for crypto info. Great source. This chart says a lot about crypto versus fiat, says Mr. Poppy. Ooh, I like this. Shout out to Mr. Poppy. Shout out, brother. He's loved member of this community. Personal friend of mine. Sent us this chart. I like the way you have this laid out. I should have done something like this. Very clean way of displaying. Looks like Ethereum, Bitcoin, Euro, while also looking at the Dixie. Probably a better way than I did it. The way I did it looks really confusing. But here we are. Here we are, guys. I hope you're hype. Less than 8 minutes. Optical art, you're welcome. Good to see you, brother. You're funny at 1.5x. It's 100% CNBC. What? I thought 75 was it, and we got confirmation. 17K next point. Steve's looking for long. Yeah, I mean, that's where I would look if we see a breakdown for sure. I would personally look at like 17.2. 17.2 is never actually tested. It's never fully tested. We hit 17.5. That was kind of like just shy. 75. We're here in 75. Are you going to steam live? I'm steaming live right now. Can't you feel my energy, bro? Can you feel my energy? I'm steaming. Right meow. Right meow. The whole market just got a shakeup. Stocks, though, seeming maybe they're waiting for Cherpoww. SVGBP is El Salvador. Looking moonish, IR Brandon. Looking moonish. The moonish? I have too many charts up now. Close some of these charts. Rube. Let's see. Can we see this actually like any... We can't really see it on any meaningful time frame. These are daily updates. It does look like it... No, wait. The last data point is December 2021. So I don't know how to look at this chart. What? I mean, that looks moonish. Looks moonish if it's frozen from 2021. March 2022. Yeah, this chart doesn't seem very useful to me. Can't do candles. Oh well. It was worth a shot. It was a good look. All right, looks like the shock from the 75 BPS is in. Shock's in. Bitcoin sold off. Dollar pumped on the hike. We saw pretty extreme moves on the euro. Pretty extreme moves really on everything. Gold dumped right on time, but it has retraced. It's interesting, actually. Gold dumped and it's kind of back to where it was. However, I've warned you guys, well, not warned, but I was talking of my caution over the last few weeks of gold breaking its multi-year low. Not a great look. Not a great look for gold. What doesn't make sense, if you guys saw that video, is gold is supposed to be the the hedge against inflation. What's going on? Why is gold breaking multi-year lows when inflation is running hot enough that we are forced to have hawkish monetary policy? 75 BPS. I don't know. Bitcoin's down too. At least it's not alone. The euro hit a new low, but has retraced some of it. I think if it trades back above 98 here, we can consider it kind of back on course. I already have an alert here. I don't need to set another one. But for the euro to see something like this would not be surprising either. Kind of just come back to where it fell. It would not be a big shake up. Dollar looking... I mean, it showed so much strength there on that announcement. But was it hype? Was it just hype? Because that was a big candle. That was a big 1 minute candle. And now it's retracing. Let's actually do a little TA. We have less than 5 minutes for Cherpoww. Stay engaged. Stay chatting. Stay hype. Could come back down to 111.142. And that's still just a 618 retrace. Isn't even like a retest of the highs. This is very local. We're on the 1 minute. It's not recommended. Not recommended to be on the 1 minute. There we go. It will be interesting. To me, this looks like speculation, but the reaction globally, all these currencies just uniformly dumping on what was already considered like what was going to happen. It's a little sus. One beardy day soon. Am I opening a position after the official announcement? We'll see. We'll see. I don't know. Litecoin halving is nearer than Bitcoin's. You caught up now, ADD Dad? Well, I'm ADD Tom. Thanks for being here, bro. You hope it takes until 2024 for rate hikes to finish so you get 2 more years of Tom Crown streams. I mean, bro, we did these before they were interesting. We made these interesting. You guys out there, we made these interesting. Now everyone does them. We were doing them when no one liked them, and we'll be doing them when no one likes them again. That's our motto. That's our motto. Dollar looking very close to that 618 retracement. Wouldn't be mind-boggling. Let's look at the equivalent move for Bitcoin. Probably in the exact same spot, to be honest. Wow, look at the precision. Sometimes Bitcoin is so clean. Look at that. From our swing high to our swing low, the 618 retracement, what we were just looking at on the dollar. Perfect. Perfect. On the 1 minute candle, perfect. To where it rallied before the announcement. That would be some very clean TA to see a return to 19.5. A rejection from there would be pretty brutal, though. Pretty brutal. All right, we are minutes away. Minutes away. Let me make sure Cherpow's ready. Mr. Cherpoww. Mr. Powell. Where are you, Mr. Powell? There you are. Wait, I need to, like... There we go. I got my alert for 2 minutes out. Less than 2 minutes to go. We're going to silence our music. Turn that down a little bit for now. Wow. FOMC blasting us with volume today, it seems. You don't need that much volume, FOMC. Your chilling, waiting music is appreciated, though. Why did you stop? Oh, it hasn't. That's just an 18-second clip. I thought that maybe they had started the loop. They have not yet. All right. We'll take about 90 seconds of some silence. Not actual silence, but no music. We're going to collect ourselves. We're going to prepare for Cherpoww. While we do that, smash the likes and subscribes. Drinking game. Yeah, I'll have to look. Are you allowed to drink on YouTube? Is that like kosher, legit? Is that, will I get in trouble for that? Like, will they come after me if I do that? Because I'm down to have like some kind of drinking game, one of these. Not today. I got to keep sharp today. Today is the day I have to be sharp. But maybe the next one. We'll see. We'll see. Cherpoww is speaking in 50 seconds. Get hype, guys. Put something in the chat. Put something in the chat. SB, I'm a grown man. Yeah, dude, but YouTube is my judge, jury, and executioner. Mitch Ray drinks. Yeah, that's true. I don't think about that. Get hype. Put something in the chat if you're here. What's up, Grant M? Cryptogenic Dude, Marius. Kelly Boy, Rave Song Records, The Real Guatman. Everyone's here. Omar, Bitcoiner. Shout out to Bitcoiner. Are you the real Bitcoiner? Message me on Twitter for the real one. Gold Dragon, what's up, bro? Slow Gains. Oh no, Y2K. One of my favorite people. Marius, David, Svetlik, Dean, Low. Pump me daddy. Ugh, pump me Gina. Charles Saint, Jermaine Mansour, Answar, a Kane Obe with the red magnet. What's up, man? Go to the moon, Eth. Good to see you, brother. Joker's wild. Love these streams. Love you too, bro. I love all of you. Steve, optical art, of course. Steve, feel free to throw your link in the chat, guys. Steve is a very talented analyst. You guys know I don't say that often. We disagree often, but that doesn't mean he's not talented. Tommy V, Jay Reardon. I hope you guys are ready because it should start now. I'm going to refresh it. See if... Here we go. Here we go. Turn back up the volume. Make sure it's not muted. I'm not hearing anything. Go. Shh. It's Cherpoww.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2%
How's
goal.
the volume? Let me know.
We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone.
Not very stable on
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point.
75 BPS.
And we anticipate that ongoing increases will be appropriate.
Boom.
We are moving our
hawkish.
policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions.
Cherpoww.
Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate.
That's not good.
Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025.
Gold is
Participants
going
continue
nuts.
to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina, yes, Gina, if you have a question. Gina.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question
Answer it
directly,
now.
but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular. to achieve a period of growth below trend, and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
GINA again, please. Second question.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you
Leisman.
talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy?
If he says no,
on the rate increases. Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go.
That man
is it linear?
Head.
Do you keep raising rates, or is there a pause that you could envision where you kind of figure out
the same question,
what has happened to the economy and give time to catch up in
so
the real
I said
economy?
they may
The
slow
rate
down.
increase time to catch up in the real economy. Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Okay, Rachel.
GINA again, please. Only GINA.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
No soft landing.
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect.
Gold just
because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. And as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just repeating himself.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
The dollar is broken lower. WTF.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lengths, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation inflation expectations, I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with
Looks just
Reuters.
like
Thanks
Stones.
for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75.
So if nothing changes, yes.
You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that.
AKA
I would
yes if
say
nothing
that,
changes.
we're committed to getting to a restrictive level of
is this
for the
India
federal
50?
funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a
Inflation
good
has not
measure
come
of where
down.
inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Gina, again? Can we just hear from Gina? Or Rachel.
Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios.
I think he wants to
A number
fight
of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
About in mentioning other rates.
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways
There's a Cherpoww
higher
there.
interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your
that mic
colleagues
sucks.
said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
Get this guy.
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on
The dollar not digging what
on
he's saying.
interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds
not.
now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So
keeps
the
repeating
median
that.
forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
They keep asking me. He's not going to say.
Hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So, I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Sure.
Thank you, Chairman Powell.
We have
Nicole
some
Goodkind,
spicy-
CNN
Ooh,
Business.
Nicole, listen.
Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
Everything's rebounding. Like JPY.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation.
Eating it again.
And that could be, you pick your measure. It could be, there are all kinds of different things you could pick, and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go.
Cherpoww.
Thank you very much.
Cherpoww. He's done. That was it. Walk off, Mike. Comp looking pretty good. XRP, look at these moving averages on daily for Comp BTC. That's pretty wild. Just broke. Goodbye, Cherpoww. Thank you for picking GINA first. I do appreciate that. We called on her. They picked her. Well, they're always a little boring towards the end. They're always boring because he never answers anything. Basically this. He said, we're not at our goal. We're working towards getting to the goal. He wouldn't speculate. He's like, we made our decision based on... So what he's saying is, we're going to continue with this unless something changes. So we're going to expect 75 again next month, probably, unless we see CPI come in low, come in cold. Doubt it. Interesting price action for sure. On the rate hike release, we saw the dollar explode to a new daily high after already sitting at daily high, multi-decade high. We saw Bitcoin dump. We saw virtually every other currency eat it. Stocks ate it. And it seemed as if once he started talking, That got changed up. We were talking even pre-meeting how this does happen quite often. We were seeing this sell off on the dollar, and we're saying, well, a lot of time into the hike, we'll see whatever direction it's going at reverse. And it kind of seems like we saw it then reverse again once he started talking. On the 1 minute, this actually does look like potential reversal. On a low 1 minute time frame, might have some kind of neck there. We could see a bounce. I'd bring Bitcoin down, but that's 1 minute TA. Don't follow 1 minute TA. It is telling that the dollar fell, which is weird because I think what he said was very hawkish. He deflected all questions that were really related to stopping interest rate hikes, easing, and he just kept pointing to the job market, to real inflation rates, etc. Kind of as expected, but also as expected, this was one of the best streams in the world because you guys were here. Period. I don't even know how many people tuned in today. It was freaking awesome. I love you guys. We're gonna do more. But this has been like 2 hours. Everybody needs a break. Guys, we hit 420. Go forth. You have your license. You know what to do. Jump in the Discord. If you're new, if you haven't jumped in the Discord, we're gonna do a live airdrop. You'll get some sats. I'll make you a Bitcoin holder just by being in there. You just have to click the verify button. Make sure you liked and subscribed to the stream. Definitely sign up for the newsletter. It's free, and there's going to be a really, really big announcement in the next few days in it. So you're going to want to be on there. Definitely. Jump in the Discord. Check out our sponsors in the video's description below. Bybit and Market Cypher. Shout out to them. Keeping our lights on during these bearish markets. And shout out to you guys for being here. Really, you are the champions. You're the reason we're here. I love you all. Love every single one of you. You guys made today awesome. Over 9,000 hawkishness on the poll. Right on. Right on. Join me tomorrow. We'll probably be live doing some TA, so I look forward to you guys joining me then. I'll see you in the Discord. GINA,